Unsurprisingly, over the past few days, the main trigger was a sharp escalation between the US and Iran. At one point, markets reacted to a clear ultimatum from Donald Trump: reopen the Strait of Hormuz or face potential strikes on energy infrastructure. Iran's response only added to the uncertainty, though. They were direct threats towards regional infrastructure. The situation seems to become more confusing rather than clearer. We saw reports of renewed strikes by Israel in Tehran, followed by a sudden pause in US action, and then claims of productive talks. Later, a 15-point peace plan was proposed by the White House. However, Iran signalled it had no intention of holding direct talks, even as a US proposal to end the war is under review by senior officials in Tehran. So from a market perspective, there was no real resolution, only shifting narratives. Oil initially moved lower on headlines suggesting there were negotiations, but that move lacked conviction, and markets are not fully pricing in de-escalation as yet. Equities showed the opposite reaction. Indices such as the Euro Stoxx 50 and the FTSE 100 dropped to levels last seen in 2025 before rebounding, although the recovery was limited. This is not trend behaviour, it's uncertainty-driven price action. Looking at forecasts, analyst views remain divided. Karen Young from Columbia University's Centre on Global Energy Policy expects oil prices to remain in the $80 to $100 range through 2027. At the same time, Oxford Economics projects Brent crude could reach around $110 to $114 per barrel in the second quarter. Now, according to CNBC, the oil market is currently in backwardation, meaning near-term contracts trade at a premium to later deliveries, signaling expectations of lower prices over time. As there seems to be no real progress in the US-Iran tensions, any forecast may materialise depending on future events.